In the first two parts of this series, we framed private credit as the bank killer, a parallel financial system that surged ahead when traditional banks, tied down by new regulations, pulled back. On the surface, it looked like a clean break. Regulation clipped the bank's wings, and private funds swooped in to take over. A classic David versus Goliath story. But if you walk into the back office of a major global bank today, you'll find a very different reality. The banks aren't fighting private credit anymore. They are financing it. Welcome to the secret handshake, the quiet, symbiotic relationship that reveals banks and private credit aren't rivals at all. They're two halves of the same financial circle. Here's the central irony of modern finance. Private credit funds, the very same ones that market themselves as alternatives to banks, are now among the bank's most important clients. The IMF recently estimated that bank lending to private credit and private equity funds has surged to nearly $500 billion. This isn't some accidental overlap. It's a deliberate, highly profitable partnership happening through two critical and largely invisible channels. First, you have what are called subscription lines. Think of this as the fund's safety net, or more accurately, its institutional credit card. When a private credit fund wants to close a deal quickly, it often hasn't yet called the capital it needs from its investors. That process can take weeks. So, instead of waiting, the fund borrows from a bank. It's a massive line of credit that lets the fund move instantly. The bank, in return, earns steady, low-risk interest, secured against the promises of the fund's very wealthy investors. Then you have NAV loans, which stands for net asset value loans. This is like a second floor of borrowing. Banks are now lending to funds against the value of the loans the fund already owns. It's leverage, quietly layered on top of existing leverage. Why do banks love this so much? Well, to regulators. Lending $1 billion to a diversified fund looks much safer than lending that same billion to a single, risky company. This means banks can hold less rainy day capital against these loans while still earning attractive returns. It's the same money, just with lower friction. Now, let's look at this from a different angle. Picture yourself as a CEO. You walk into your longtime bank asking for a $200 million loan to fund a big acquisition. The bank's credit committee looks it over and says, no, the deal is too complex, too bespoke, too risky for their highly regulated balance sheet. But this is where the story changes. Today, the bank doesn't just send you away. It becomes a concierge. The banker says, I'm sorry, we can't do this loan, but let me introduce you to a friend of ours. That friend is a private credit fund. The fund makes the loan. The company gets its capital. But the bank stays involved, structuring the deal, servicing the loan, and advising on the transaction. For this, the bank earns a nice fee. Everyone appears to win. The bank gets a fee without taking on the direct risk. The fund gets a pre-vetted borrower, and the company gets its capital. The only loser here is transparency. The risk hasn't disappeared. It has simply migrated from a tightly regulated, publicly scrutinized bank balance sheet into the quieter, less visible world of private credit. But the ultimate handshake, where this relationship becomes truly systemic, is through something called significant risk transfers, or SRTs. This is the financial engineering that glues the whole system together. Banks are required by law to hold a certain amount of capital against all the risky loans they make. This capital is expensive because it's money they can't lend out or invest. To free it up, banks increasingly use SRTs. Here's how it works. The bank keeps the loan on its books, but it sells a slice of the potential loss on that loan to a private credit fund. In exchange for taking on this piece of the risk, the fund receives an ongoing fee from the bank. For the bank, SRTs act like a pressure valve. They can expand their lending and make more loans without having to raise more expensive capital. For the funds, it's a way to earn steady, predictable income for essentially insuring the bank's risk. But this makes the financial system much harder to map and far more difficult to trust us. The connections are hidden in plain sight. So, why does this change everything? Think back to the 2008 financial crisis. Back then, risk sat at the center of the system. Big banks were the hubs. When one of them, like Lehman Brothers, failed, the shock was immediate and obvious. The whole system shuddered. Today, risk is spread across a distributed web. It's not concentrated in one place. Each individual node looks stable on its own. The banks hold credit lines to the funds. The funds hold the actual loans to companies. And investors like pension funds and endowments supply the capital to the funds. But the connections between these nodes are opaque. If a major private credit fund stumbles, the impact isn't isolated. It hits the banks, who might have to pull their credit lines. It hits the pension funds, who will see the value of their investments marked down. The risk hasn't been eliminated. It's been distributed. And here's the real plot twist. We used to worry about shadow banks operating completely outside the system, but now, the shadow and the bank are holding hands. They are partners. This new architecture is incredibly efficient and adaptive. It allows capital to flow to places it couldn't before. But it also means that a problem starting small can travel fast and quietly across institutions that don't even realize how deeply connected they are. In this new world, the web doesn't snap, it vibrates. And the biggest danger isn't a sudden collapse, it's delay. A slow, creeping crisis that builds in the shadows before anyone in charge even realizes it's happening. If this part revealed the hidden connections, our next part will expose the blind spots. Join me for part 4, where we step into the fog, a world where defaults are quietly rewritten instead of declared, and zombie companies are kept alive through accountant alchemy. Make sure you're subscribed so you don't miss it. Thanks for watching.